Budgetary signals a gradual shift in India's financial sector strategy. Proposals such as a market-making framework for corporate bonds, total return swaps, bond index derivatives, an infrastructure risk guarantee fund and right-based recycling of CPSE assets indicate recognition of a deeper structural issue: India's overdependence on banks for long-term corporate financing. Unlike advanced economies, India lacks a deep corporate bond market. Government securities are nearly 90% of GDP, but corporate bonds remain around 15% of GDP, far below levels seen in the US, Germany, or China. As a result, banks finance nearly 60–65% of non-financial corporate debt, compared to about 30% in the US. This structural imbalance forces banks to carry long-term infrastructure risks despite being funded primarily by short-term deposits. Such maturity mismatches heighten systemic vulnerability. When large projects fail or stall, losses hit bank balance sheets directly, often requiring government recapitalization over ₹3.2 lakh crores since 2017. This effectively socializes private credit losses, creating fiscal burdens and crowding out credit to MSMEs and new borrowers. A shallow bond market also weakens monetary policy transmission as stressed banks adjust lending rates unevenly. Deep capital markets, in contrast, distribute risk across investors and reprice credit efficiently. Thus, Budget 2026 attempts to rebalance India's financial architecture by shifting risk from banks to markets. The long-term resilience of India's financial system will depend on whether corporate debt markets deepen enough to complement rather than overburden the banking system.